Good morning, everybody, and welcome to this Wednesday, January 15th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, the first thing I think you need to prepare for in the trading day ahead is a webinar that we're going to have tonight. It is an impromptu webinar. I don't do these very often. But I do want to mention that I am seeing a number of warning signs, a big number of warning signs in the market. I know the market just keeps pushing along, but I don't think every day is the same. And I do believe we are running into some headwinds. Doesn't mean the market's going to pull back. I've seen secular bull market advances before just go through everything. But it would, I think it certainly behooves me to at least provide some of those warning signs. So the first thing I want to do is share to show you first EarningsBeats.com. If you go over here, there is a tab toward the top that will say free trial. If you click on that, it will take you to this landing page. Also in my blog article this morning, over at Stock Charts, I decided to write a quick article talking about a couple of the things I'm seeing negative divergences, which I'll show you in just a minute. But I also had a link in here from there. I think this is a pretty important webinar tonight because as a short-term trader, if you're a long-term trader, I wouldn't even be worried about the market pullback. I'm still very bullish. I believe we're in a secular bull market. I think that any pullback is going to be short-term oriented. But as a short-term trader, I think it's really important because you can see a lot of profits dwindle pretty quickly in a market where we get a pullback, even if it's just for a couple of days to a couple of weeks. So I wanted to go over those market warning signs tonight with all of our members at EarningsBeats. So if you're not a member, we have a no-cost January 4-pack that we're calling. You can go through and take a look at these events that are coming up. It's not just the events, it's the whole service. But these are some big events that are coming up. You can take a look at this. Let's go ahead and move on to the market and what happened yesterday. May not seem like a whole lot. There was a reversal. You can see the Dow had set a new record high, got up above 29,000 again. We did come back down off of that, finished at 28,939, which was still up 32 points for the day. The S&P 500 remains in its uptrend here, as you can see, but it was down 5 points. The NASDAQ continues to power ahead, set a new high yesterday, but did reverse and finish 22 points lower. We saw some pretty good action in the small cap group, and this has been a group I've been a little worried about because the relative strength has been moving lower again, just set a new low relative to the S&P 500. You can see why. I mean, we've actually, since the third, fourth week of December, we had been moving lower until yesterday, finally moving up and setting at least an intraday high. And during that period, the S&Ps continued moving higher. So we've fallen back into that pattern of underperformance by small cap stocks. I believe that's going to change in 2020. Maybe we need to really see a big reversal, though, before we get excited by it. I just think that small caps have been underperforming for a long time. And historically, when you go through a period of a year or a couple of years of underperformance, that is typically followed by a couple of years at least of significant outperformance. So I do think we're going to reverse, but trying to time it's been very painful of late. 10-year Treasury yield, I'll tell you, this is one of the warnings. I don't like this uptrend that's being broken today. Moved down another 3.3 basis points, 1.785%. This isn't a long-term problem, but short-term, when you get a breakdown of a trend line in the Treasury yield, Treasury prices move opposite the yield. So Treasury prices are moving up. That's what's causing the yield to move down. Why do Treasury prices move up? Money rotates into defensive areas. When the market starts to get more defensive, you want to be careful if you're in equities. XLV Healthcare leading the action. That's a defensive group. Utilities yesterday breaking out to a new high, defensive group. Staples, the third best performer, trying to break out to a new high, defensive group. Now, on the downside, we did have real estate, which is also a defensive group that was lagging. Looks like maybe it just went back and tested this breakout level, though I would expect it maybe to push back higher today. We'll see. Technology, though, second worst performer. We haven't seen that much lately. Look at this push to the upside in the technology group. So technology stocks a little weak yesterday. We did have a couple economic reports out today. December PPI came in at 0.1% rise. Market was expecting 0.2%, so it came in a little below expectations. Core PPI did the same thing, 0.1% rise versus 0.2%, or 0.2% expected rise, so came in below expectations. That was just like CPI yesterday. Both December CPI and core CPI came in below expectations. PPI, core PPI below expectations. The increase in wages that we saw in the non-farm payrolls last Friday came in below expectations. This is helping in that it is not going to put any pressure on the Fed whatsoever to raise rates. So if there was, if there's some out there saying, well, things are starting to pick up, the stock market's picking up, that means the economy's picking up, we need to raise rates. Well, you don't really need to raise rates when inflation's not a problem. You need to raise rates when that growth results in inflationary pressures. We're not seeing that right now. And the data that's coming out is not showing that the Fed needs to be concerned about it. So this is not going to be a problem in 2020, at least not at this point. At some point later in the year, we might start to see an uptick in inflation data and in commodity prices and so forth, especially if the dollar weakens a bit more, as I suspect it probably will. That could, at some point, lead to higher interest rates. But I don't think it's going to be significantly higher. I think it'll be slightly higher, and we are already near historically low interest rates. So I don't think interest rates are a problem, even though you will start to see it. If the rates do begin to rise, if we see the 10-year Treasury yield get back up above 2%, that'll be the new normal on CNBC, seeing the headlines on rising rates. That'll be the next scare. Let's see. Let's take a look at I wrote about this in my Trading Places blog this morning. Just a couple of the warning signs I'll give you right here. We don't have time for this during the show to go through all the warning signs, and I got a lot of other things I want to talk about. But let me just show you a couple of them here. First of all, the S&P 500. This is an hourly chart going back the last month. And if I annotate this, you can see that previously we had these highs in play. And right here, the PPO was coming down lower, and you can see what happened, 2 or 3 days of weakness. And normally when I see these negative divergences, that's what I expect. Here, we actually had it here, and we just went sideways for a little while. Didn't really go down. Then we broke back up again with lower PPO once again, so that's like a triple negative divergence. But eventually we did weaken for a bit. We reset that PPO, went a little bit below the center line, went below the 50-day, set an important low, which has been holding, and then we broke to new highs. I even talked about the possibility of a topping head and shoulder pattern back here, if you recall. So right there, you can see left shoulder, neckline, head, right side of the neckline, right shoulder. These topping patterns, you got to be careful because a lot of times they don't execute because you're in an uptrend. You're not necessarily topping. And we didn't break that neckline. We held it. Ended up moving back up above the head. That negates the pattern. So the pattern's gone. Now we've got higher prices. Let's go ahead and do this again. So now what are we looking at? Well, there's your higher prices. Here is your lower PPO, negative divergence. So once again, what I'm thinking, okay, short term, we're probably looking at something like that, where we'll come back down, test the center line, test the 50-hour SMA, very similar to what we did over here. Maybe go a little bit below it. Maybe we test this low. Maybe we go down to that prior low right here, a little bit below the 50-hour. I mean, that's kind of what I would be looking at if I was just looking at the hourly chart. If this was the only problem I saw, then I'd say, okay, maybe we're looking at 1% pullback, which isn't that big a deal. I mean, over a couple of days, nice little pullbacks, nothing wrong with that, little basing. But that's not all I'm seeing. So that's the hourly. Step out to the weekly. Now the weekly, if I annotate, seeing very similar action. Here you can see the prior high at the end of December and where we are right now. And here we've got a lower PPO. So we've got negative divergence. Now, last time we did that, we had higher prices, had a slightly lower PPO. We did take a big hit over 2 or 3 days, but we did end up bouncing before we got to the 50-day. It was very short-lived heading into December. I think this one could be a little bit more than that. If you go back to the last time we had one prior, it would have been back here. Slightly higher prices there and lower PPO right there. And you can see we had a pretty significant drop, sideways consolidation, came back up, equal highs, back down one more time. This was our ascending triangle. Or if you remember, I had talked about this uptrend, equal highs, rising lows, a breakout above 3,025 would measure to 3,225. Well, we're 3,283. We've made that measurement now. We've got the negative divergences. This could be, an area where we want to be a little careful. All right. Let me go over to the XLK. Now, this has been one of the best areas of the market. You can see on the daily chart, the PPO is still fine, no problem here. But when I zeroed in on an hourly chart, I noticed that technology having a little bit of a problem here too. Higher prices, lower PPO. Last time we saw this over here, lower PPO, we went down to that 50-hour, sideways consolidated. So maybe 94, that would be a 1% drop roughly, again, just like the S&P, no big deal. Do want to mention that when we made this push up, we had a reversing candle here at the top. Anytime I get a negative divergence, reversing candle, that's a bearish engulfing candle. I know it's just an hourly chart, but we had a gap up and a failure. That normally gets me a little bit more cautious. Notice throughout the entire day yesterday, we rebounded, but we couldn't get through that high. And then we came back down and finished at a new low at the end of the day. Short term, I think that's a little bit of a problem. If I didn't see anything else wrong with the market, I probably wouldn't even do anything. I probably wouldn't even adjust my trading strategy, not for a possibility of a 0.5 to a 1% pullback. But I think we could be in for a little bit more than that. I do also want to mention that if you go over here under the member tools at stock charts and you pull up the sector summary, you can see yesterday healthcare led, as I mentioned at the top of the show, healthcare, utilities, consumer staples, energy. Energy is not defensive, but it's also not aggressive. Market yesterday, 4 of the 5 groups that led yesterday were not aggressive. The only one that led that was aggressive, industrials, went up 0.01%, 1/100th of 1%. Congratulations. There was the big move in the aggressive area of the market yesterday. But what's starting to worry me a little bit more here, and I'm going to move on to earnings and upgrades and downgrades, but one last thing, and I've got a bunch more I want to talk about that I think a lot of sentiment stuff that I think you need to be aware of and some charts that I follow. But look at the 1 week performance here. Now, technology's had a good week. That's good. But look at what has followed. Real estate, consumer staples, and utilities over the last week. Those are 3 of the 4 top performers are defensive groups, pure defensive groups. That normally doesn't happen. I mean, that has not been happening over the last 3 months. If we go back and look at the last 3 months chart, we got technology, healthcare, but if you pull up healthcare, look at biotech, 16%, healthcare providers, 27%. The more defensive area of healthcare is really pharmaceuticals. So when I look at that healthcare, it's really more the aggressive areas of healthcare that are rising. Communication services, financials, and industrials. The only aggressive group that's not leading here in the top is consumer discretionary. And you can see consumer stocks were leading in 2019. They've definitely, we've seen rotation. They're taking a bit of a back seat. But look at where the defensive groups are sitting. Real estate, utilities, consumer staples, right where they're supposed to on the bottom. But over the last week, they're moving back toward the top. Now, that ought to tell you something. And then when you combine that with what I just went over with the 10-year Treasury yield, where we're the last week, you see the yield rolling over? That means money's rolling or moving into Treasuries. If we take a look at the TLT, last 3 or 4 trading days, starting to see a little bit of a rally. That is just telling us the market is turning a little bit more defensive. You don't really see that when we just take a look at the S&P 500. You just see a market that just keeps going higher. It doesn't look like any other period in here, but under the surface, we are seeing some things change. So I just wanted to point that out. All right, and again, please check out the webinar for tonight if you're not already a member at EarningsBeats. Just a lot of really good information, some charts I think that will give you some ideas of what to look for in the future when you probably should grow a little bit more cautious. And when I say I've gone cautious, I sold all my trading stocks yesterday. I went to cash. Late yesterday afternoon, I just said, you know what? I don't want to take a chance. I saw the big thing that I saw was that XLK chart coming back down at the end of the day. And that's been the really big leader. When you look at the relative strength charts of all the sectors, I mean, technology's been straight up. And I know one chart or one day's action, but it's just that on top of everything else. Here's the XLK. And you can see this is a 5-day, 10-minute chart. And we had opened high, came back down, tried to rally up, and then rolled over and closed near the low of the day. And that was just enough for me with everything else going on. But there are a lot of sentiment stuff. Market makers, believe me, it behooves them to bring prices down here over the next, I'm going to say, couple of days to a couple of weeks. And so that's got me a little nervous as well. And also, you know, let's watch earnings reports and see what happens when these earnings reports come out. A lot of companies have been rising into their earnings reports. If they can't sustain it after earnings come out, that would be another warning. Buy on rumor, sell on news. Okay, let's move on here. I want to talk about some earnings reports. They are starting to come in, some bigger companies. First one is Bank of America. Bank of America came in today. Their revenues matched expectations, $22.3 billion. Bottom line, they beat those, 74 cents versus 68. Not shocking there. Beautiful move up. The bank group's been moving up. Bank of America, clearly a leader. Did not beat on the revenues, though, so it's not going to be part of our strong earnings chart list going forward, unfortunately. But there will be other banks that we can trade for sure. I still like the banking group. But chances are, if the 10-year Treasury yield keeps moving down, that's not going to be a good backdrop for the financials, especially for the banks here in the near term. So some of these earnings reports coming out, it might be a buy on rumor again, sell on news. And I'll talk about a couple more of those in just a minute. But let's first take a look at United Health. United Health missed on their top line. They came in at $60.9 billion. Market was expecting $61.2 billion. So a little bit of a miss. They did beat on the bottom line, 390 versus 377. This has been a pretty good leader. It's pulled back over the last month or so as it's been consolidating here. But otherwise, it's been a pretty good leader. I'd watch the 50-day moving average. I do think UNH was down a little bit in pre-market when I saw. So keep that in mind. But watch that 50-day moving average. USB. Another bank, US Bank Corp. This one's been pulling back recently. They did beat on their top line, but they just matched bottom line, $1.08 versus $1.08. But I would be staying away from it. A stock like this that is near its 52-week relative low to its peers, if I like its peers, I'm going to find one that's performing well, not one that's underperforming. Also, notice at the top, as it started to roll over, look at the volume. This is not light volume. So I don't know what's going on with USB, but I would stay away. Goldman Sachs, this one was a little surprising for me. I wrote about this one on Monday. Great looking chart. Volume coming in. Look at that relative strength. But they missed on their bottom line, 469 versus 520. Stock was only down a couple of dollars pre-market. I think it's got a good shot to maybe push back to this 20-day moving average. And because it missed on its earnings, it will not be included in the strong earnings chart list going forward. But I still think the chart looks good. I mean, pulling back, holding that 20-day. If I was just trading and not just trading off the strong earnings chart list, I really like the chart. So it could be that Wall Street seeing something further down the road that it really likes, maybe more mergers, acquisitions, more companies going public where Goldman Sachs can make a ton of money, trading, picking up, that sort of thing. So I like the chart, but I do think it's got a chance here to come back down in the mid to low 230s for a test. BLK, this is BlackRock. Beat on the top line, beat on the bottom line. Really nice looking report, nice looking chart. 20-day test would probably be a good entry. Last one I have for today, PNC. This is a stock that is in one of our portfolios. We love PNC. Great looking chart on a relative basis. This is one of the leaders. Volume trends on this stock is much better, as you can see, tracking action to the upside. PNC did beat on the top line, 4.61 billion versus 4.48 billion. Easy beat there. 297 versus 292 in terms of earnings. So really nice action there. And I believe the stock is up in pre-market to around 161 and change. Be careful though, because it could be, again, buy on rumor. Now the news is out. We could see more consolidation. I think a pullback anywhere near that 50-day, maybe just below 155 to test this breakout level would be an area where I think you'll see traders get involved in it again if it pulls back. I'm not saying it's going to, but I wouldn't be surprised. All right, let's move on to upgrades and downgrades. I want to take a look first at CHRW. This is CH Robinson Worldwide. Truckers kind of have my eye because I do think that truckers, you can see this big move coming up here, trying to break out. I think truckers could be the leading area of transportation. I think the economy is going to strengthen. I think transports are going to be great in 2020. And the truckers are starting to show that here, moving higher so far in January. But CHRW has not been one of the leaders. That's a problem. Now, it is coming up here, and it's been testing this gap resistance level. Will the upgrade help? I think it definitely is looking better, but it's got a little bit more work to do. I don't think this has been one of the leaders. So even though the stock's being upgraded, I don't really trust this upgrade. I would be a little careful with CHRW. I do like the group, though, so I'd look around in trucking. ECHO, another stock getting an upgrade. This is in transportation services. The group just broke out, but once again, we have a stock that has been mostly downtrending. Now, I see the volume coming in here just as we make this move in relative strength. Maybe this is starting. I do like that test of the 20-day moving average. It's at least beginning to show signs that it is moving back to the upside. A 20-day test, or maybe even a pullback to test this breakout around 2110 or so, those could be two areas to consider. But if it loses its 20-day moving average on a closing basis, be careful because of this chart. Again, maybe it's starting to strengthen. Maybe this is the start of a big run and the group is just breaking out. This could be a great performer, but just watch that 20-day moving average. All right, MNTA. This was one of my favorite stocks in biotech. Whoops, that didn't work out very well. This has been one of my favorite stocks in the biotech area. I've been talking about it. Look at the relative strength. It's been climbing for quite a while. I didn't own it. I wish I did. But this has been a great performer. Big breakout. Look at the volume coming in, the pullback holding the 20, and look at the breakout yesterday. Today, they're now getting upgraded by, I think that was JP Morgan that upgraded the stock, gave it a price target of $30. It's gone up too much for my blood to try and chase it at this point, but I would at least keep this one on your radar. It's one of the best performers in the biotechs. And if the biotechs make that breakout above 2,200 right there, that measures up to 2,900. So being in one of the leaders wouldn't be a bad thing or a bad place to be. One other trucker. Let's pull up WERN, Werner. Werner Enterprises. Now, this one looks a little better to me, and you can see not that long ago, less than 2 months ago, it was setting a 52-week relative high versus the truckers, and it's pulled back as it's consolidated, but it looks to me like it's broken that downtrend here. What I see is off of this uptrend. I'm going to annotate this one. Now, to me, this is a much, much more attractive trade. Here you can see the tops, and here you can see the bottoms. And essentially, we have this little bit of a squeezing. It's like a bullish wedge. Maybe it doesn't squeeze as much here. Call it a channel, maybe. But the point is, it's pulled back to its breakout area, which was right about there. See the double top? We got the breakout, increasing volume. Came all the way back down, tested it. Nice little doji, false breakdown. That is what I love to see, these tails that look like they're breaking below support. Folks get stopped out. Somebody's buying. It wouldn't be me intraday. I wouldn't be looking at that and saying, hey, let's buy. It's breaking down. Market makers jump in. This is the way they can accumulate some shares. So they jump in. Look at what's happened since. stock going back up. I think Werner looks good. I expect that this one will see a breakout at some point. So this one, I do like that upgrade. All right, downgrades, Beyond Meat. This one has been on fire. I think probably all the way through this period. You got the lockup period that expires after 6 months. So May, you see a lot of selling sometimes leading in to a lockup expiration because they know that insiders are going to want to get out. And so this is not unusual sometimes for these high-flying new public companies as they get close to lockup. They come down, then the lockup expires in November. You can see all the shares, folks that taking their money or whatever, gets to a point where it kind of runs out, and then we start to move back up again. I like this pattern. I don't like yesterday's black candle, and I don't like this test of the 135 to 140 area right up here. Kind of see the tail here? I mean, I could even drag it down here. This is a pretty big level over in here as well. So I could go from there, which is the low close, to right here, which is off of this huge gap up. You can see the lowest point that the sellers came in, which is around 120. And notice we went right up into this zone and put in that black candle. The black candle is a reversing candle. So it's downgraded. I think that the big downtrend is over on Beyond Meat, but I wouldn't be surprised with all the volatility. Somebody buying at 135 yesterday, if this stock's down at 100, they're going to be panicking out. If you lose $35 on the stock, what's that, 30%, something like that, 28%. If you lose that kind of money in one day, you're going to be panicking out of a stock. And so that's the problem with trying to chase a rally like this. Get a big reversal, you got to pay attention. I expect we're going to come down, maybe get a 20-day test. That would be all the way back down at 86. Now that's coming up pretty quickly, but literally in a couple of days, this stock can move 20, 30 bucks very quickly. So not for the faint of heart, that's for sure. All right, let's look at one more downgrade here. And this is actually one of our portfolio stocks, and it's been a great performer in the internet space. CDLX, Cardlytics, huge move to the upside. This is probably a valuation downgrade. I completely disagree with this downgrade. It could pull back, but this is a great looking stock in the internet space. Great volume trends, huge uptrend in play. If I wasn't in it, I would, and I'm not in it, by the way, I would be looking for $75. Pullback, that's the top of gap support. If it got back down there at some point, that would probably be a great buy. All right, let's move on. Running out of time here, so let's go into the three you must see. First one is PRGO. I just want to point out on Perigo, this huge move yesterday, making this breakout, closing at $57, up 12.6%. Again, I wouldn't chase it, but this is starting to show signs with that big volume that this was a bottoming and exhausting type of move to the downside. Now we're starting to move a little bit higher, made this move to $57. Again, I'd have to see a little bit of a pullback, but we are starting to see at least some positive action in PRGO. So it's one worth watching. Now, EXEL, this is in the biotech space, and this one's starting to show signs of accumulation. The volume coming in, here was a move up, holding that 20-day moving average. We went back down, put in a beautiful bullish engulfing candle. See the move back down on light volume, coming right back up 3 days in a row. 3 white soldiers, nice volume. Pulled back one more time yesterday, we break out. So this is one, when we look at it on a relative basis, not been a great performer. See if I can get this up here. Okay, so hasn't been a great performer, as you can see, but starting to move up. This is about a 3-month relative high now for EXEL. Volume coming in, higher highs, higher lows, really nice candles. These big hollow candles, to me, suggest accumulation. Maybe we get another pullback, but I think that rising 20-day moving average is going to start to look pretty appetizing the way this stock is turned. And then my last stock is LLY. If you're looking for stocks maybe to think about taking profits on, I'd be looking at a stock like LLY. Here, it's been a leader. I don't think this is a bad stock. Don't get me wrong. Higher prices, lower PPO. Watch for a reversing candle. Also, look at how overbought. RSI is now at 90 on the stock. I'm not even going to get into the fact that there's probably a number of options, call options in the money as options expire. So be real careful with Eli Lilly. All right, those are the 3 you must see. That is the show for today. Again, want to just point you to the free trial. If you go over to EarningsBeats.com and you click on the free trial, it'll bring you right in here. You can go down here and sign up. It's a no-cost opportunity to come in, and that'll get you into the webinar this afternoon, which will be certainly worth the price of admission since the price is $0. Anyhow, everybody have a great day, and be back here on Monday. Be back at Stock Charts TV for Trading Places Live tomorrow at 9 a.m. Have a great day, everybody. Happy trading.